Maarten, good morning to you. So you say markets look set to start on a better footing as many of the uncertainties were addressed somewhat in 2019. I want to ask you, where is this confidence coming from with the geopolitical tensions where they are at the moment?
Yeah, I think, if you look at last year this time, we had to deal with Brexit. We basically had very uncertainty around the trade negotiations between the US and China. So, I think to an extent, some of those have been addressed throughout 2019. So we know that Brexit is going to take place at the end of this month. We basically going to sign a phase one deal between the US and China. So from that point of view, some of the major geopolitical uncertainties has been addressed over the past year. But I think we've been reminded again just in the last 2 weeks that, geopolitics will always be with us, and just what's been happening in Iran just shows again that, those kind of events will cause volatility in markets.
Yeah.
So typically geopolitical events will cause uncertainty and volatility. So, it's nothing that we can put behind us. And again, Iran and some others that we don't even know about will definitely impact markets for the rest of 2020. But that aside, if we just look at the economic fundamentals, 2019 we saw some softness in global economic growth. Most indicators suggest that that's bottoming out. So we're likely to see some rebound in economic activity for 2020. And very importantly, I think this is an election year in the US. And typically in an election year in the US, despite what's been happening in Iran at the moment, but that might be part of the plan, is to say that they will do whatever they can to actually create an environment that's good for the US consumer, which is typically good for the economy and also for markets. So there's a couple of things that's playing out that's quite different compared to last year this time. And probably the most important one is the fact that in this current environment, we're also seeing that 70% of central banks are actually cutting interest rates or are supporting their economies. Again, if you go back to last year this time, the Fed was still talking about hiking rates. And now, like I said, most central banks are actually cutting interest rates. So we're in an environment where there's more monetary and fiscal stimulation supporting economies. There's a likely rebound in economic activity. Yeah. And although the geopolitics and the risks are still there, the biggest ones are being addressed. So that creates an environment where we do think that, markets can see some risk on rallies from time to time. But I think it's very important to understand that we see this as an opportunity to start taking profit because we're getting to the end of an 11-year bull market. So this is something that can't continue forever. And like you've mentioned, there are some risks in the pipeline. So rather use these opportunities to actually take profit and make your portfolio more defensive.
Maarten, on the local front, you mentioned the ever-present threat of a Moody's downgrade. Talk to us about how investors should better prepare their portfolios for that kind of challenge if it should come along, because also there is this constant talk about a possible recession, not just on the local front, but also globally.
Yeah, I think if we first turn to the downgrade, we probably should have been downgraded long ago if you look at the data, and that was confirmed again by the budget in October, the medium-term budget. So the numbers are not looking good. We in injury time. I don't think there's enough time to actually do what needs to be done by February next month to actually please the rating agencies. So at this point in time, I think the likelihood for a downgrade is quite high. A lot of that's already been priced into the markets. If you look at what's been happening over the past 2 years, a lot of the foreign bondholders have been leaving the market, the net sellers of our bonds. But even, if it's priced into the market on the day of such an announcement and the sentiment around that, it will definitely impact our markets, the currency, the bond market and the equity market. So how do you prepare for that? I think at this point in time, probably be more defensive, be probably underweight or lower duration South African government bonds. That's what we're doing at the moment. That is still a great asset class. It's a good diversifier. But, at the moment you get 9% plus in those investments. When the downgrade comes, that market is likely to take a knock and those yields might even start trading at double digits. And that will be probably a better entry point into that market. But at that point in time, if you think about South Africa seeing with inflation of 3.78% at the moment. So if you can have an investment in your portfolio that gives you about 9-10% and inflation is only 3-7%, 3.7%, and you're probably in a tax-friendly vehicle like a pension fund or a tax-free savings plan, nowhere else in the world will you get that guaranteed real return. So that remains quite attractive from that point of view. Then yes?
No, I want you to conclude your thoughts there on the last one.
Yes, and just maybe on the potential global recession, like I've explained, we think it's probably only likely 2021. And part of our strategy is to say, well, use this opportunity that we already referred to, where in this year we can still see some rallies in risky assets, use that to take profit, and think about more defensive strategies like protected equity, definitely the bonds, like I've explained, and then cash in your portfolio to actually protect for the next couple of years, which we think is probably going to be a little bit tougher compared to the last couple of years.
All right, Maarten Ackerman, thank you very much for waking up with us here on The First Take. Is with Citadel Asset Management.